Welcome to the video on managing multiple bank accounts and credit cards. Today we will unpack when to consolidate and when to keep accounts, with a practical framework focused on value versus complexity. We will move step by step, cover actionable strategies, and test your knowledge with quick quizzes along the way. First, we will explain why consolidation matters. Next, we will evaluate bank accounts and credit cards separately. Then, we will visualize the decisions with diagrams. After that, we will walk through a practical step-by-step plan. Finally, we will test your understanding with quizzes and wrap up with key takeaways. Now, let us set the stage. The core principle is that value must exceed complexity. Complexity includes monitoring headaches, higher risk of compromise, and added tax reporting. Value includes unique benefits you cannot replace, such as special tax advantages, required insurance bundling, or critical local ATM access. Next, let us tackle bank accounts. Keep accounts that deliver essential utility, such as unique tax benefits, required insurance bundling, or critical local access to ATMs. Maintain accounts that are truly fee-free and deliver services you value. Conversely, close accounts that add monitoring friction, create extra 1099 INT tax forms you do not need, or no longer align with your goals. Streamlining reduces the risk of compromise and simplifies your budgeting. Moving on, this flowchart starts by asking whether the account provides unique value. If it does, you keep it. If not, you check whether the account is truly fee-free and actively used each month. If that is also not true, you then consider whether it causes monitoring or tax complexity or adds security risk. If yes, you close it. If not, you may optionally keep it depending on personal preference. This gives you a clear decision path to reduce unnecessary accounts. Now let us address credit cards. The golden rule is to always pay in full every month so that your statement balance is zero. Do not close one of your oldest cards solely due to age. That card helps preserve your average age of accounts. Eliminate cards that charge annual fees yet deliver no meaningful benefits or that you simply do not use. Maintain low utilization across the cards you keep, ideally below 10 to 30%, to protect your score. Finally, focus on rewards you actually redeem. Furthermore, this pie chart illustrates credit utilization. With 15% used and 85% available, the ratio is healthy. Generally, lower utilization supports better credit outcomes. Higher total limits combined with low balances improve the ratio, but this only works if you pay in full consistently. Meanwhile, here is a quick comparison. Keep accounts that provide unique tax benefits, required insurance bundling, critical ATM access, or are truly fee-free and valued. For credit cards, keep your oldest line to preserve account age and keep those with benefits you redeem. On the other hand, close accounts that levy annual fees without real benefit, sit dormant, or generate extra 1099 INT forms and monitoring headaches. Also, close overlapping products that add complexity without incremental value. Next, this table maps common signals to actions. Annual fees with no value usually indicate you should close, especially for credit cards. Your oldest line of credit is generally worth keeping. Unique tax or insurance benefits are strong reasons to keep a bank account. High monitoring or tax complexity points to closing. Truly fee-free and used accounts may be worth keeping depending on your usage and needs. After that, follow these steps. First, inventory all accounts, fees, benefits, usage, and autopays. Second, categorize each by value versus complexity, considering tax perks, ATM access, insurance, and rewards. Third, migrate autopays and direct deposits to your keeper accounts. Fourth, close no value, fee-heavy, or unused products, prioritizing bank accounts first. Fifth, for credit cards, keep your oldest line and close redundant fee cards after redeeming rewards and, if possible, reallocating credit limits. Sixth, target under 10 to 30% utilization and enable autopay in full. Finally, schedule an annual review and security audit. Next, here is a quick quiz. The question is, you have 5 credit cards. One is your oldest and has no annual fee, but you rarely use it. Should you close it? The options are A, yes, close it to reduce clutter. B, no, keep it because it helps your credit age. C, Close it only if utilization will drop. D. Close it and open a new rewards card. You may pause the video now to think about the answer. We will discuss the answer in the next section of the video. The correct answer is B. Keeping your oldest no-fee card helps preserve your average age of accounts, which can support your credit profile. Use it occasionally to keep it active, and set autopay to cover charges in full. Now, a second quiz. Which bank account is most worth keeping? The options are A. Fee-heavy account with no unique benefits. B. Account that creates extra 1099 INT forms and hassle. C. Fee-free account that provides required insurance bundling. D. An account you opened for a one-time bonus and never used. You may pause the video now to think about the answer. We will discuss the answer in the next section. The correct answer is C. Essential utility wins. A fee-free account that provides required insurance bundling is a strong reason to keep it. Next, this timeline lays out an annual cycle. In the first quarter, inventory accounts and fees. In the second quarter, review rewards and utilization. In the third quarter, complete a security audit by updating passwords, enabling multi-factor authentication, and setting alerts. In the fourth quarter, prepare for taxes by tracking 1099 INTs and consider closing low-value accounts before year-end. Then, repeat annually. Additionally, here is a simple one-page policy you can copy. It states your mission is to maximize value and minimize complexity. For bank accounts, keep those with unique tax benefits, insurance bundling, or critical ATM access, and those that are truly fee-free and used. Close accounts that generate extra 1099 INTs, create monitoring headaches, or overlap in purpose. For credit cards, always pay in full, keep your oldest no-fee line, and close fee-heavy no-value cards after redeeming rewards. Aim for under 10 to 30% utilization. Operationally, move autopays and direct deposit to keeper accounts, set alerts and multi-factor authentication, and calendar an annual review. Before we conclude, a quick disclaimer. This content is educational and not financial, tax, or legal advice. Consult a qualified professional who understands your situation. Terms, fees, and credit scoring factors vary by issuer and region. Always verify details directly with your institution before acting. To summarize the key takeaways, value must exceed complexity, or you should consolidate. For banking, keep essential utility and fee-free value, and close the rest. For credit cards, pay in full, keep your oldest no-fee line, and cut fee-heavy cards that do not deliver value. Protect utilization by aiming under 10 to 30%. Schedule an annual review and security audit. Finally, your next steps are straightforward. List all your accounts, then cut the noise. Keep only what you use and value. Pay in full and maintain low utilization. Review annually and keep your setup secure. This rhythm keeps your financial life lean, rewarding, and resilient. Thanks for watching. If this was helpful, please like, share, and subscribe. Tell us in the comments what you plan to streamline first.